Right now, somewhere in your city, someone is sitting across a desk from a bank manager. They want a loan. Maybe it is for a house, maybe a car, maybe a small business they have been building in their head for 3 years. The bank manager looks at their credit score, their income, their history. There is some paperwork, some waiting, and then the loan is approved. Here is what most people think happens next. The bank goes into a vault somewhere. It finds the money that other people deposited. It takes that money and hands it to the borrower, a transfer of existing funds from one place to another. That is not what happens. The bank types a number into a computer. That number did not exist before they typed it. And just like that, money exists that did not exist 5 minutes ago. No printing press, no vault, no transfer of someone else's savings, just a number entered into a ledger, and the money supply of the economy quietly grows. If that sounds impossible, or illegal, or like something that should require more ceremony than typing a number, you are having exactly the right reaction, and the fact that most people never question it is one of the most consequential gaps in public financial understanding in the modern world. Let us establish why this matters right now. Every conversation about inflation, about housing prices, about student debt, about why money seems to buy less than it used to, connects directly back to this mechanism. You cannot fully understand any of those things without understanding where money actually comes from. Most people assume money comes from the government. The central bank prints it, the Treasury manages it, it enters the economy through some official channel, and some money does work that way. But the vast majority of money in circulation in any modern economy was not created by a government. It was created by commercial banks, private institutions, making loans. In the United Kingdom, the Bank of England published a paper in 2014 that stated this clearly and directly. Quote, "The majority of money in the modern economy is created by commercial banks making loans." End quote. That is the central bank of one of the world's oldest financial systems, saying quietly in an academic paper what almost nobody teaches in school. So let us understand exactly how it works. The concept you need is called fractional reserve banking. Sounds technical. It is actually a very old and very simple idea with very large consequences. Here is the basic structure. When you deposit money in a bank, the bank does not lock it in a safe with your name on it. It lends most of it out. It keeps a fraction in reserve, hence the name, and puts the rest to work as loans. Historically, regulators required banks to keep a specific percentage of deposits in reserve. In the United States, that requirement was 10% for most of the 20th century, which meant for every $100 deposited, the bank could lend out 90. Now here is where it gets strange. The $90 that gets lent out does not disappear into the borrower's pocket and vanish from the system. The borrower spends it. It goes to a contractor, a car dealer, a supplier. That person deposits it in their bank, and their bank now has $90 as a new deposit. So their bank keeps $9 in reserve and lends out $81. And that $81 gets spent and deposited and lent again, and again, and again. $100 of original deposit moving through the banking system can generate up to $1,000 of loans. The original money multiplies, not through fraud, not through sleight of hand, through a process that is entirely legal, entirely standard, and almost entirely invisible to the people whose economy it shapes. This is called the money multiplier, and it means that every dollar that enters the banking system does not stay a dollar. It becomes several dollars, sometimes many several. Now let us make this even more concrete and slightly more unsettling. When a bank makes a loan, it does not actually need the deposit first. This is the part the textbooks often get wrong, or at least incomplete. Modern banks create deposits when they make loans. The loan comes first. The deposit is the result. Here is how it works in practice. You apply for a $100,000 mortgage. The bank approves it. In that moment, the bank creates two entries in its ledger. On one side, an asset. You owe the bank $100,000. On the other side, a liability. Your checking account now shows $100,000. The bank has not moved money from anywhere. It has not drawn down reserves. It has created a matching pair of entries, a debt you owe and a deposit you can spend. That deposit is money, real money. Money you can use to buy a house, pay a contractor, transfer to a seller. It functions in every practical sense as money because it is money, and it was created the moment the loan was approved. The Bank of England, again in that 2014 paper, put it this way, quote, "Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money." End quote. They published this. It is publicly available. It received almost no mainstream coverage. Now, the question you are probably asking is, what stops banks from just doing this forever? And the answer is several things, none of which are quite as reassuring as you might hope. First, capital requirements. Banks are required to hold a certain amount of their own equity against the loans they make. This means they cannot lend infinitely, because eventually they run out of the cushion that regulators require. Second, demand. Banks can only create money by making loans, and someone has to want the loan. If the economy is contracting and businesses and households are not borrowing, banks cannot simply conjure money into existence. The mechanism requires a willing borrower on the other side. Third, the central bank sets interest rates. Higher rates make borrowing more expensive, which reduces demand for loans, which slows the creation of new money. This is actually the primary mechanism through which central banks try to control inflation, not printing or destroying physical cash, adjusting the price of borrowing, which adjusts how much money the banking system creates. So the controls exist. They are real. But they are calibrated controls on a system that, by its nature, can expand the money supply very rapidly when conditions are favorable. And history suggests that when conditions are favorable, the temptation to expand is difficult to resist. This is where the implications get large. Every time credit conditions loosen, every time interest rates fall, every time lending standards relax, the banking system creates money. New money chases existing goods, assets, houses, stocks. Prices rise. People feel wealthier. They borrow more. Banks create more money. Prices rise further. You have just described every major asset price boom of the last 50 years. The housing bubble of the 2000s was not primarily caused by reckless individual borrowers or greedy individual bankers, though both existed. It was caused by a system that, under the conditions of the time, was creating mortgage money at an extraordinary rate. Between 2003 and 2007, the total value of outstanding mortgage debt in the United States roughly doubled, not because the Federal Reserve printed more dollars, because banks made more loans. And when those loans went bad, the money did not just transfer to someone else, it disappeared. Just as money is created when loans are made, it is destroyed when loans default and are written off. The supply contracts. Suddenly, there is less money in the system than there was before. Prices fall. More loans go bad, more money is destroyed. This is deflation, and it is one of the most dangerous economic conditions that exists because it feeds on itself in the same way that credit expansion feeds on itself, just in the opposite and far more painful direction. Here is the quiet irony sitting at the center of all of this. We live in a world where the word money carries enormous moral weight. We talk about earning it, deserving it, saving it, wasting it. We build entire philosophical frameworks around its value and its relationship to human effort and virtue. And the mechanism by which most of it is created is a bank typing a number into a spreadsheet. The money in your account right now, the money you worked for, saved, budgeted around, worried about, almost certainly exists as a digital entry in a commercial bank's ledger. It is not backed by gold. It is not stored in a vault. It exists because at some point in its history, a loan was made somewhere, and the banking system expanded to accommodate it. This does not make it fake. It functions as money because everyone agrees it does.
The system works because confidence in the system holds, which is to say, money is real in exactly the same way and for exactly the same reason that it has always been real. Collective belief. But knowing the mechanism changes something. It changes how you read news about interest rate decisions. It changes how you understand housing price cycles. It changes what you hear when a central banker talks about controlling inflation. They are not talking about managing a fixed supply of a scarce commodity.
They are talking about adjusting the rate at which private banks are permitted and incentivized to create new money from nothing. And this brings us to the question that does not resolve cleanly. If commercial banks create money by making loans, and the volume of those loans shapes the price of everything from houses to groceries, then the effective control of the money supply, the thing that most profoundly affects your daily economic life, rests significantly in the hands of private institutions whose primary obligation is to their shareholders. Not to you, not to the broader economy. To their shareholders. The central bank sets the conditions, it adjusts rates, it issues guidance, it acts as lender of last resort when the system trembles. But the actual creation of money, the moment-to-moment expansion and contraction of the supply, happens inside private banks making individual lending decisions. You were probably never taught this in school. The Bank of England basically confirmed the mechanism in a paper most people have never read, and the economy continues to operate on this foundation every single day, for better and for worse and for everything in between. So the next time you hear that interest rates are rising to fight inflation, you will know what that actually means. The central bank is making it more expensive for private banks to create money. It is turning down the dial on the machine that built the modern economy, the machine that almost nobody knows exists.